Hello, yeah, welcome back to class. Now we are taking what we are taking chapter 8, leases, accounting for leases. Okay. Now to start with, let's take the definition of lease. Okay, definition. Uh accordance to IS 16, okay. An agreement, lease is an agreement whereby the lessor conveys to the lessee in return for a payment of series of payments the right to use an asset for an agreed period of time. So when an asset is being given to a third party or to someone for use, okay, in order to earn the benefits arising from enjoy the benefits coming from the use of these assets, okay, and a substantial payment is what is allowed, okay, series of payments is allowed to the what to for a return, okay, as a right to use an asset for an agreed period of for an agreed period of time. Okay, so a lease is a way of obtaining a use of an asset such as a machine without purchasing it outrightly. Okay, so the company that owns the asset is known to be what to be the lessor. Okay, and this allows another party, it allows another party known as the lessee, okay, to use the asset for a specified period of time, for a specified period of time. Okay, and in return for a series of rental payments, series of rental payments. Are we together? So IFRS 16 removes the finance lease operating lease distinction for leases. In the previous standard on leases, that's IAS 17. Okay, IAS what? That's IAS 17, inception date of lease. Okay, sorry, I'm explaining something before now. Oh, okay. So I said that IFRS 16 removes finance lease operating lease distinction for leases. So the new rule which is IFRS 16. The new rule require a lessee to recognize all leases on the statement of financial position. So IFRS 16 does not change how lessor should account for leases. It does not change how lessor should account for leases, but only affect the accounting treatment of the lessee. Are we together? Now the inception date of a lease. Now the earlier of the date of a lease agreement and the date of commitment by the parties to the principal terms and conditions of the lease is the inception date of the lease. Okay, is the earlier of the date of a lease agreement and the date of commitment by the parties. Okay, so if the date of commitment precedes the date of agreement, then the date of commitment shall be recognized as the inception date of the lease. And also if the lease agreement comes before the date of commitment by the parties to the principals and conditions of the lease, then such will be taken as the inception date. And the commencement date of a lease is the date on which a lessor makes an underlying asset available for use by a lessee. The date of commencement of the lease is the date in which the lessor makes available the use of an asset available by a lessee. Now, what are the lease term agreement? Now, the lease term agreement is that for the non-cancelable period for which a lessee has the right to use an underlying asset together with both one periods covered by an option to extend the lease if the lessee is reasonably certain to exercise that option, and the periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise that option. So this is the lease term. Okay, it is for a finance lease. Okay, for a finance lease, or let's because this distinction has been cancelled. Okay, so though finance lease still exists and operating lease still exists. Okay, what is removed is what is the distinction between the uh is the distinction between the finance lease arrangement or operating lease arrangement for the lessee. Okay, so for lessor is still what is still remain. So now for lessee and for finance lease and operating lease, it has similar treatment now. Okay, so now the non-cancelable period for which a lessee has the right to use an underlying asset is the period covered by an option to the extent to extend the lessee or the lease if the lessee is reasonably was certain to exercise that option, and the period covered by an option to terminate the lease if the lessee is reasonably certain not to exercise that option. Now, how is lease payment treated? Okay, now payments made by a lessee to a lessor relating to the right to use an underlying asset during the lease term comprises the following. It comprises the fees payment less any lease incentives. Okay, if the fees payment is say 1 million naira and the incentive is say 200,000. Okay, so the fees payment less any incentive is what, so the lease payment will be 800,000 and not 1 million, because there's what, it's just like having a discount on purchase of an item. Okay, so also variable lease payment that depend on an index or a rate. The exercise price of a purchase option if the lessee is reasonably certain to exercise that option. Are we together? And also payment of penalties for terminating the lease if the lease time reflects the lessee exercising an option to terminate the lease. Okay, payment of penalties for terminating the lease if the lease term reflects the lessee exercising an option to terminate the lease. Are we together? So are you there? So now, okay, we have a residual value. Okay, we have a residual value. So when a company that owns an asset leases it to another party, they have two interests in that what, they have two interests in that asset. First interest is that it gives them a right to receive a series of rentals over the lease term, and they own the asset at the end of the lease. So the value of the asset at the end of the lease is called its residual value. Okay, it's just like it's the value of an asset when the useful life expires. Okay, so now, or when at the end of its use, it can be put to sale. Okay, so the residual value is when a company that owns an asset leases it to another party that have two interests in that asset. The first interest that is gives them right to receive a series of rentals payments over the lease time, and they also own the asset at the end of the lease, and the value of the asset at the end of the lease is called its residual value. Are you together? So now, residual value guaranteed and unguaranteed residual value. Difference between what residual value guaranteed and unresidual value uh unguaranteed residual value rather. Now, residual value guarantee, a guarantee made to a lessor by a party unrelated to the lessor that the value of an underlying asset at the end of a lease will be at least a specified amount. Residual value guarantee is a guarantee made to a lessor by a party unrelated to the lessor that the value of an underlying asset at the end of a lease will be at least a specified amount. So that value is guaranteed. And unguaranteed residual value is that portion of the residual value of the lease asset. Unguaranteed residual value is that portion of the residual value of the lease asset and the realization of which by the lessor is not assured or is guaranteed solely by a party related to the lessor. Now, for what for the guaranteed residual value, it is what is a party unknown or unknown to the lessor. It is not related to the lessor, but the price is being guaranteed. Okay, at the end of the lease time of this lease. Okay, the assets could still be put to use, or the residual value for this asset will still be 300,000. Okay, so that is guaranteed by party unrelated to the lessor. And for unguaranteed residual value is that, this the realization at the end of this asset, the amount at the end of this asset is what is is not cannot is not certain that it will, but it will we are realizing 300,000. Okay, so we are unsure of what to be realized. Okay, so it's not what is not assured or is guaranteed solely by a party related to the lessor. Are we together? Now let's discuss the interest rate implicit in the lease. Okay, now the rate of interest that causes interest rate implicit, mind you we are still taking definition of times, right? Now interest rate implicit is the rate of interest that causes a the present value of the lease payments and the unguaranteed residual value to equal the sum of the fair value of the underlying asset and any initial direct cost of the lessor. The interest rate implicit is what is the present value. Now if the present value of the lease payment is what is say 1 million, okay, is what is say 1 million, and the unguaranteed residual value, if the unguaranteed residual value is say 200,000. Okay, so we have what we have our 2 million. This 2 million equals to the sum of the fair value of the underlying asset. Okay, so if the fair value of the underlying asset is what is say 1 million, and any initial direct cost of the asset, initial direct cost of the asset is what is 100,000. Okay, so we have 1 2. Okay, so mind you the present value of the lease payment has been discounted to this 1 million naira. No, so in the discount rate used, okay, the discount rate used is what is the interest rate, implicit to arrive at this 1 million, plus the unguaranteed residual value that equals the fair value, plus the initial direct cost incurred in the by the lessor. Are we together? So then what is the initial direct cost? Okay, what is the initial direct cost? Incremental cost of obtaining a lease that would not have been incurred if the lease had not been obtained, except for such costs incurred by a manufacturer or lessor in connection with a finance lease. So if not for the lease if not for the lease, okay, the lessor wouldn't have incurred the cost. Okay, so that's why it is the incremental cost of obtaining a lease that would not have been incurred if the lease had not been obtained, except for such costs incurred by a manufacturer or lessor in connection with a finance lease. Are we together? Then let's take the treatments of lease accounting. Lease accounting. A lease is capitalized at the commencement of the lease term, and this involves the recognition of the asset that is subject to the lease and the liability for the future lease payment. A lease is recognized at the inception, at the commencement of the lease term. It is recognized at what? It is recognized at the commencement. Note it. It is recognized at what? It is recognized at the commencement of the lease term. So it involves what? It involves the recognition of the asset that is subject to the lease and a liability for the future lease payment. Okay, so we also have lessees incremental borrowing rates. Okay, or lessees incremental cost of borrowing. So now the rate of interest that a lessee would have to pay to borrow over a similar time and with a similar security the funds necessary to obtain an asset of a similar value to the right of use asset in a similar economic environment is what is referred to or known as the lessee's incremental borrowing rate. So now let's assume the lessee has entered into a lease agreement, okay, to purchase an asset, okay, for let's say 2 million naira. Okay, so what we are saying here is that the lessee's incremental borrowing rate or rate of borrowing is the rate that will be charged in the on a similar term, okay, with a similar security if the lessee has decided to go to bank to go and borrow this 2 million naira in order to purchase that same asset. Okay, in order to purchase that same asset. So the asset is being purchased through lease arrangement is what is 2 million naira. Okay, so now this 2 million naira, if it will have been borrowed in the market, okay, not we are not taking the cost price, okay, or the cash price of the assets. Okay, the cash price of the asset might be 1.5 million or 1.6 million, but due to the fact that it is a lease agreement, and the payment is what is substantial, okay, it is a series of payments, so it has an element of interest. Okay, so but what we are saying here is that the leases incremental borrowing rate is what is the similar term, okay, is the amount or the rate of interest that a lessee would have to pay to borrow over a similar term and with a similar security the funds necessary to obtain an asset of a similar value to the right of use in a similar economic environment. So now the assets will be purchased at the cash price of 1.5. Okay, so now if the guy is going to borrow 1.5 in the bank, what's the interest rate he will be charged on that? Okay, or if he's going to borrow 200 million, what's the interest rate to be paid? So the interest rate to be paid on the amount of 1.5 million borrowed is what is the leases incremental borrowing rate. Are we together? So other issues are in IFRS 16 is what is the recognition exemption. Okay, so in IFRS 16, a company can elect not to apply the lessee accounting rules to short-term leases and leases for assets of value, okay, of low value, such as laptops, mobile phones, and some other gadgets, okay, that of lower or low value. Okay, so the entity has a choice of applying the lease accounting or not. Okay, and the election must be made by class of short-term leases, but may be made on an asset basis for low value assets. Okay, the election must be made by class of short-term by class must be made by class of short-term, okay, of short-term leases, but may be made on an asset basis for low value. May be made on an asset basis for low value. Are we together? Okay, so that's that. Now portfolio application. The rules in IFRS 16 set out the accounting rules for individual lessees. Set out the accounting rules for individual lessees. Now let's take a presentation. Now, how do you present a lease in the statement of financial position? Now, the right of use must either be present or presented separately in the statement of financial position or disclosed in the notes. Now, if you have the right of use to the asset, then that is, you lease an asset, it should be presented separately as a separate line item in the statement of financial position. Finance lease, or you say lease the assets. Okay, let's take that way. Lease assets. So this does not apply to right of use asset that meets the definition of investment property, which must be presented in the statement of financial position as investment property. So if it meets the definition of investment property, or it meets the definition of property, plant and equipment, such should not be recognized as a lease asset in the statement of financial position. Are we together? So it is only the right of use that apply to leases, okay, or lease. Okay, so this does not apply to right of use of asset that meets the definition of investment property. Are we together? Now let's take the statement of profit or loss. In the statement of profit or loss, interest expense on the lease liability must be presented separately from the depreciation charge for the right of the use. Okay, so the depreciation charge, okay, should be presented separately. So it depends on the area. It depends on where the asset is being put to use. So if it is put to use for the sake of production, okay, so you include it in the cost of in the cost of sales. Okay, if it is used for administrative purposes, then you include it in the administrative expense. And if it is for delivering purposes or distribution of goods, okay, you include it in the distribution cost, while the finance cost or the interest paid on on the borrow on the lease will be classified as as finance cost and should be recognized separately. Okay, should be recognized separately as a line item in the statement of P or L. So in the statement of cash flow, how do we treat a lease asset? Cash payment for the principal portion of the lease liability must be classified within the financing activities, must be classified within the financing activity. So short term is uh short term lease payments, that is payment for lease of low value asset, and variable lease payments not included in the measurement of the lease liability are classified as operating lease. So any short term lease, any short term lease payments or for asset that of low value, they are classified as operating activities. Are we together? Okay, so now let's take the disclosure requirements of IFRS 16. Disclosure requirements of IFRS 16. The following must be disclosed under IFRS 16 leases. Depreciation charge for the right of use of assets by class of underlying assets should be disclosed, and interest expense on lease liabilities should also be disclosed. Expenses relating to short-term leases of low value assets, variable lease payments are also required to be disclosed by company under IFRS 16. Income from subleasing right of use assets should also be disclosed, and the total cash outflow for leases should be disclosed. Additions to right of use assets should also be disclosed, and gain or losses arising from sale and leaseback transactions are also to be disclosed. To wrap it up, for any standards you are trying to understand or learn, or you are taught, try to know these 5 key steps. Okay, know the definition of the standard, know the recognition criteria, know the measurement or know the measurement criteria, know the presentation of the asset, or sorry, of the underlying assets or standard discussed. Okay, and also know the disclosure requirements. I can boastfully tell you that there's no situation or circumstance where what an examiner will ask you question that will go out of these 5 elements. Is either he asks you question pertaining to the definition and recognition, though it might be on a scenario based. Okay, and it is your understanding of this definition of the underlying for instance, maybe you are asked to the examiner decide to test you on impairment. Okay, so it might bring he or she might bring a scenario that requires you to know the definition, the key terms in the definition, the recognition criteria, and the measurements. Okay, and yeah, if you also want to test your knowledge on how to treat the impairments. Okay, so it might ask you about the recognition, measurement, and the presentation, and it might ask you also to make some disclosure. Okay, so it is now left to you to what you need to study hard, so that you get yourself familiar with terms used in this study, and also you are so as to be able to help you, or to enable you perform well in this coming exam. We should go there to represent us, and I'm very sure that you are a winner. Okay,